Perfect. Welcome, folks. We're just going to take a quick moment to let a few folks into the webinar here. So hopefully everyone's having a great morning on Tuesday here. And thank you so much for joining us. So, yeah, as we get started here, it's my pleasure to introduce our speaker for today, Rebecca Frederick. My name's David Beta, and I'm with Business Link. And again, thank you for everyone joining us here today. So as we get started, today's webinar will be on investigating insolvency when facing financial uncertainty. So quite a popular topic, I know. And just reminding everyone joining us for today's webinar, please remember to keep your audio and video off during the presentation. And if you'd like to ask a question during the webinar, we are encouraging people to ask questions throughout if they need to please click chat in the meeting controls and type a message in the chat box. And so the information provided in this session is for general knowledge and should not be taken as professional advice. So it's my pleasure to introduce our webinar presenter today, Rebecca Frederick with Frederick and Company Limited. And I have a short bio here, I'll just read that out. So Rebecca Frederick is a licensed insolvency trustee who worked at large national firms for over a decade when she decided to open her own firm, Frederick and Company. She's passionate about helping people find the answers they are searching for. She provides unbiased information to help clients make informed decisions about how to best move forward. Frederick and Company now employs 5 staff, all of which are dedicated to helping people get the answers that they need. Rebecca is also on the board of directors for the Alberta Association of Insolvency and Restructuring Professionals and has been asked to speak numerous times at educational forums for their national association, CAIRP. In addition to running a business, she is currently homeschooling her 3 children, while her husband, an accountant, is still working hard during the extra long tax season that the COVID-19 pandemic has brought all of us. So yeah, it's my pleasure to introduce Rebecca, who will take things over from here. And like I said, if anyone has questions throughout, definitely type those in the chat box and we can look at getting through those. So yeah, take it away.
Thanks so much, David. I really appreciate the opportunity to be here today with all of you to talk about an industry that I love. I love insolvency because I get to help people on a regular basis. So I get to help people kind of hit reset and find either that they're moving forward in a way that works for them and that just kind of reignites their passion to kind of move forward, or it gives people additional options like bankruptcy and proposal to hit reset if they need to. So thank you so much for this opportunity. So that's kind of, this is just a hi, nice to meet you all, and a little bit about me. I have been working in the insolvency industry, like David said, for coming up 2 decades, which seems rather crazy when I look back. So I have a bit of experience to kind of pull on. As David said, this is just a general overview of insolvency terms, considerations, and examples. The slides can't be construed as legal advice because really, at the end of the day, what's most important is that you get advice that's tailored exactly to you and your specific circumstances. And that's far more valuable to you than general considerations. And so just want to throw that out there. So now that we've had that kind of overview, let's talk about some strategies for dealing with your creditors during this pandemic. I think the hardest part about COVID-19 and the pandemic and shutting down of businesses and that kind of thing is that we are really in a situation where we don't really know what the future holds. And so it's definitely in a time where there's a lot of uncertainty. And so right now, with all that uncertainty that exists, not only for you, but also for your lender and everyone, it's people really need to we just need time to figure this stuff out. And so really the best course of action for you when dealing with your creditors is to keep in contact with them. I know sometimes it's scary when you don't know what's going to happen. You don't know where this thing is going and how it's going to unfold. And so talking to your creditors and saying, I don't know, can be really a tough thing to do. But it really is the best option that you have. When we're talking about when you're talking to your creditors, that keeps them abreast of what's happening. Really, surprises are the least favorite thing of creditors. They don't want to be surprised at the end of the day. And the nice thing about this particular situation is that we're all going through this together. Like the hashtag alone together. We are really, kind of struggling on our own, but we're all kind of in the same situation. And so keep that in mind when you're talking to your creditors, because, really they are, they're going to understand that. So you can see there kind of a list of bullet points. Tell them what's going on as you go, how this whole thing is impacting your business is really important. And keep in regular contact. Be the person that they don't have to worry about, because they know that you're going to be, reaching out to them on a regular basis. Really important not to make any promises you can't keep. So under promising and over delivering is a great strategy. Say like, if you think you can pay $500 a month, try to negotiate an agreement to pay $400 a month. And then if you can pay that extra bit, great. If you can't pay that extra bit, then that's okay too. They're not expecting it, right? And then seeking legal counsel. This is really important. Lawyers that specialize in insolvency are worth their weight in gold. This is not business as usual. This is something entirely different when you're facing financial uncertainty. While your corporate commercial lawyer is probably really great at that corporate commercial stuff for planning for success, really the people that shine in the legal world are insolvency lawyers when things are not going well. They're definitely going to be worth their weight in gold in terms of, having a conversation with an insolvency lawyer if things aren't going quite as planned. And so I can't say that enough. They are definitely, that is definitely someone I would contact right away if there was any issues. So let's talk about your different types of creditors that you could be owing money to, and the remedies that they have to when you default on a payment. This is really important for setting the stage for bank proposal, because it impacts kind of our discussions, as you'll see later on. So secured creditors, a secured creditor is someone you owe money to that has an asset as collateral. So in the event that you default on the loan, that creditor now can go to get that specific asset and sell that asset and apply it to the loan. These kinds of debts are like mortgages, vehicle loans, equipment leases, general security agreements that can have a security over accounts receivable or accounts or inventory. Some important some business loans can have covenants that are more than just financial. So they like a bank can offer you an operating line of credit for $250,000, let's say. But they've got caveats on there where they say, we're going to give you $250,000, but you have to give us your financial statements on a regular basis so that we know where things are at. And at different points in time, they can kind of claw back or give you more depending on what those financial statements indicate. So there are those additional obligations that are really important to not forget about. Because when we're talking about whether you default on a loan or not, sometimes you're on time with your payments, but you haven't submitted those statements to them, and that's considered a default. So really important to take that into consideration. So secured creditors, again, they have an asset as collateral, and in the event that you default on that loan, they can come and take that asset. The default on the loan is going to be written in the agreement that you have. So in your mortgage documents, it'll tell you if you default, this will happen. In the lease agreement for equipment, it's the same. So if you're wondering how this is going to affect you on all these individual bases, go back to those agreements and take a look. Okay, so that's secured creditors. And unsecured creditors are creditors that you owe money to, but they don't hold collateral in the event of a security. So when you stop paying an unsecured creditor, they don't automatically have interest in a specific asset that they can come and take. Their remedy, if you default on that agreement, is to go to court. So they could go to court. So they would be suing you. So you get documents saying you are being sued. And they would go to court requesting that the court ratify the amount that is outstanding. And so they would do that through a judgment that says, that basically the order says, we confirm that this, that this lender is owed this amount by this person who borrowed the money. It's really important. This kind of gets missed sometimes. Sometimes when we're stressed out about our finances and you get a document saying you are being sued and you have 20 days to respond. We can kind of put our heads in the sand a little bit and worry about that. That is a bad idea because if you don't defend the claim, if you don't say that I disagree with these claims that are being made, then you will be noted in default. And what that means is effectively, legally, that you've agreed to the statements that have been presented to the court. And so if you don't agree with them, it's really important to issue a defense. And again, I know just enough about this to be dangerous. This is really the realm of lawyers. And so really important to talk to a lawyer if you have a situation like this. But what I want to highlight here is what can kind of happen down the line. So again, what those worst case scenarios can be if you have a situation where you're not going to pay or you can't pay your unsecured creditors. So once they have that judgment, what can happen is that this creditor can get a writ of enforcement. And this allows them to register a writ against bank accounts, against wages, and also against property. So they could put a writ of enforcement against your house or car or what have you. So they can go and start attaching to property afterwards. And so that's one of the creditors, so unsecured creditors and their remedies. And then we have your landlord. So if you have a leased space, then you obviously have an obligation to that individual. I know that the Business Link just did a seminar on landlords and by a leasing expert. And so I'd refer you back to that webinar there. So I'm just going to touch quickly on the fact that any obligation that you have to your landlord is going to be in that commercial lease. Leases are are where your obligations really begin and end. Unlike some other obligations that are written in law, your obligations when it comes to what you owe to your landlord is going to be written in that lease. So going back to that document is really important. And again, if you default on the obligations, the landlord does have certain remedies by law. They have two remedies: one, to terminate the lease and try to go and find someone else to take your space, or they can distrain against distrain against the property that's on the leased premises. So what that means is they can come and take the property that's on that lease space and then realize on any of that property that is unsecured, that doesn't have a secured creditor that has priority, and sell that to kind of make up for the arrears that's been owing. So those are in a very extreme situation where you have a landlord owed a bunch of money. This is what these are kind of the two remedies that landlords have, but whether there's a default or not on that agreement is going to be written in that lease. Okay, so I keep telling you, go back to the paperwork. You can see it. You can see a bit of a trend here. Let's talk about Canada Revenue Agency. They're another type of creditor that you can owe money to, and there's different kinds of debt with Canada Revenue Agency. So one of them is corporate tax. So with this obligation is obviously determined when you file your corporate tax return and you get that notice of assessment. Any amount owing by the business should be paid throughout the year in installments or at the end of the year by the payment date. Canada Revenue Agency is a creditor that is they're a kind of creditor that isn't they haven't lent you any money. They haven't opted into being owed money, right? And so they are particular about having both the filings done and the payment made, and probably more so about the filings. They can understand if times are tight and you can't maybe afford to make pay all your taxes, and they'll make a payment arrangement with you. But where they kind of get their knickers in a knot is definitely when filings haven't been made. So that's when you want to go to your accountant and maybe pay your accountant to make sure that those filings are up to date, so that when you come back to CRA, they are kind of willing to have that conversation with you around payments. They become less willing to have conversations around payments with you when you're really behind on those filings. Get those up to date if you can. And the nice thing about CRA at this time is that they've extended tax season, as I alluded to in my introduction, but they've also extended the time for payment. But keep in mind that if you have till September of this year to make your, or like end of August to make your income tax payments, what's going to happen next April? You're probably still going to owe money by the end of next April, on the personal tax side, or within, I believe it's 6 months of corporate filings. So next year's deadlines are probably going to adjust. And so that's where I think we're going to get, we might get into a little bit of difficulty when it comes to this, because while we're having deferments now, the bucket, you're going to have a situation where you're still going to owe that money next year. And so we're going to kind of run up against that over time. So we'll see what, if anything, there's going to be some additional help there from the government. We'll have to wait and see. Canada Revenue Agency, you can also owe GST. And so GST is considered a deemed trust. The reason that it's considered a deemed trust claim is because, so it's deemed to be held in trust. You've collected GST, and even though you haven't held it separate and apart and in a separate bank account all by itself, it's deemed to be the CRA's money. And so because you are actually collecting money on behalf of CRA, and it was never your money, it is a deemed trust claim. And when you default on payment to GST, one of the more aggressive things that they can do is they can issue an enhanced requirement to pay. So they can issue a garnishment similar to what we talked about with the unsecured creditors, where they can try to go after your bank account and your wages and those kinds of things. But they also can issue, and that's called a requirement to pay. But they can also issue what's called an enhanced requirement to pay. An enhanced requirement to pay is a garnishee kind of on steroids. It's a garnishee that once it's issued, it cannot be stopped, because what happens is basically, just kind of in layman's terms, that if a garnishment is issued to, let's say, your customer, then any money that your customer owes you is now actually deemed to be property of the CRAs, as I believe how it works. So that's why we can't stop it, is because that property has already changed hands. And so it's really important this is why it's really important to stay in touch with your creditors and stay, having communication, because when you have communication with your creditors, these more rigid and extreme enforcement methods are less likely to happen. Okay, but yeah, this is definitely something that they can do that has a big impact on your situation. I've had situations where they have a business has a customer that really is 85% of their revenue. Well, once that enhanced requirement to pay is issued to that customer, they basically aren't going to get paid until that debt is paid in full, which makes it really hard on their cash flow, because and then that business, actually, that one that I'm speaking of, actually wasn't able to continue. So really important, stay on top of GST. Another thing that can happen with GST is a writ can be placed on your real property or on the real property of the business, or movable property like trucks and that kind of thing. And this writ now kind of acts like a mortgage, and we can't get rid of it. So really important, stay on top of that. CRA, payroll remittances, very similar. It's a deemed trust claim. The one difference between payroll remittances and GST is that this debt will never go away for the business. So even in a bankruptcy or a proposal, this debt has to be paid in full. This is the one debt that I say if you can keep on top of it, it is really the best option for you because if you have a lot of payroll remittance outstanding, then it makes restructuring your business a lot more difficult. So definitely keep on top of those payroll remittances. And they have, again, the same enforcement opportunities, that enhanced requirement to pay, as well as a writ on property.
Rebecca, if you need to pay a debt, I guess, like what's the most important debt that you should be kind of paying off first, in your opinion?
I
It
think
really depends, but.
yeah, it is so dependent on your personal circumstances, but I think your secured creditors are really important because, like, if you're a business that needs that backhoe or you need that equipment, whatever it is, to operate your business, it would be really crippling to be in a situation where that bank came along and enforced the security, and then that equipment's gone, which really eliminates your ability to make money, right? So I would say that would be a key consideration for me. Another key consideration is these payroll remittances, because they do, well, in GST, they do have really kind of big sticks they can wield when they're enforcing these debts. But CRA, honestly, they can be pretty, they can be tough to deal with sometimes. But if you sweeten them with honey, and keep in touch with them, and are always sweet as pie with them, they eat that up, and they are usually willing to kind of work with you along the way. And especially now with the COVID pandemic, they are, there's even been an article online that you can find on my Facebook that talks about how CRA is actually working to make sure that people that are in proposals right now are able to continue. So, but that payroll remittance is really a big one for sure, because that debt will never go away. And in fact, it's, I'll talk about it later, but it's one of the debts, GST and payroll remittance are one of the debts that will flow to the directors of the company. So that those become important debts to keep on top of. But when we're making payments to your creditors, it's important to try to kind of spread it around and keep everybody paid. What you don't want to do is create a fraudulent preference where you've completely preferred one creditor over everybody else, because there are legalities around that too. But now we're kind of getting down into the weeds, but that is definitely a consideration. When you're paying your creditors back, oftentimes there can be a desire to pay family and friends back, and and those people closest to you, or businesses that you've been operating, going back and forth in operations for 20 years or something like that. Want to pay Bob Septic back or whatever it is, but be really careful, because your other creditors could take exception to that, and there is legislation out there that prevents you or allows creditors to review those transactions and make sure that they're fair and that you haven't preferred one creditor over another. Yeah.
Awesome. Thank you.
You're welcome. Yeah. So let's talk about bankruptcy. Now that we know what a secured creditor is, what an unsecured creditor is, and kind of the impacts of these, let's talk a little bit about what bankruptcy looks like. Now, just so we're clear, bankruptcy should not be ever the first thing that you consider when you're looking at your financial situation. It should be the last thing on the list of things to consider. We want to look at, can we rework your cash flow? We want to be, looking at opportunities for perhaps an investor to come in, or an asset-based lender. There's a lot of other opportunities out there before we kind of hit bankruptcy, and we definitely. Sometimes bankruptcy makes sense, for sure it does, but you want to be looking at other options. And when you talk to a licensed insolvency trustee about bankruptcy, they will go through those other options with you. So we are not purveyors of bankruptcy; we are purveyors of information. So we're here to help educate you on what this looks like and what your options are. And a good licensed insolvency trustee will go through all of your options, talk about bankruptcy, talk about proposals, and talk about what other options might be out there for your, for you to consider for restructuring your business, so that you can consider all of them. So with that keep in mind, let's talk about bankruptcy, just so you kind of have an idea of what it looks like. But like I said, it should be the last thing that you should get all your information of all your options before making your decision. So bankruptcy, it is a process of rebalancing the finances of a business for the benefit of unsecured creditors. So a bankruptcy, so this doesn't, so we're talking about businesses specifically right now. And so some of this can apply on the personal side and some of it can't. So, and perhaps we'll have an opportunity to do a personal insolvency webinar at some point, but this is just business related here, okay? So rebalancing finances of the business for the benefit. So that's rebalancing, probably a better word maybe instead of finances is assets. So when you have an asset, a bunch of assets in a business, some of them are going to be secured and some of them are going to be unsecured potentially, right? Secured assets, the person that gets first dibs on that is the secured creditor. So that secured creditor is going to have the ability to kind of realize on the secured assets, but it is the unsecured assets, the unencumbered assets that don't have any kind of loan attached to them. It's those assets that would be realized upon for the benefit of the unsecured creditors. So obviously we're only looking at a bankruptcy situation where the company wants to cease all operations. All assets will be sold and then divvied up pro rata amongst all the unsecured creditors. Okay, this process can be voluntary. You can voluntarily put your business into bankruptcy, but you can also be kind of pushed into bankruptcy, for lack of a better word, by your creditors. So a creditor can make an application to court saying, providing the court with reasons why they think a business should end up in bankruptcy if that creditor. And so this is another good reason why you want to keep in touch with your creditors, because you want to stay in touch and again, under promise and over deliver, so that they always kind of believe what you're going to say. Because when a creditor gets really feels like you're no longer operating with good faith and they can't trust what you're saying, that's when they might get a little grumpy or a little antsy and look at remedies like this for themselves. Because if they know that there's a bunch of assets out there that they could realize upon to give them something, they might perhaps go down that path, but they have to go through a court process to do it. So it's not a guarantee that they would be successful at it, but it does it is a possibility for them to consider. So all assets of the business will be sold and pro rata share amongst the unsecured creditors. The secured creditors have first dibs on the assets they have a specific interest in, and the trustee is responsible for selling the unsecured assets in a transparent sales process. So it's our job to make sure that the sales process makes sense for the asset that is being sold, and that we can realize the most for creditors by minimizing our fees and making sure that the process makes the most sense, where you can kind of get sell the asset for as much as possible. And so that's kind of bankruptcy, and I'm going to go through an example of bankruptcy. But basically that's it in a very, very general nutshell. And of course, we're talking about everything at 10,000 feet here. We're looking at this, very generally. The statements I'm making, like I said, throughout this whole website are very general statements around bankruptcy and proposals. And so if you want that specific advice, definitely talking to a trustee makes a lot of sense. So a proposal. What a proposal is, it's a process for keeping the business operating. The business is not going to shut down, so the business is going to. So this is only for a business that is viable, that is sustainable. If we could just deal with our debts, and make a deal with them, we would be viable and could carry on. A proposal is where proposals can kind of fall flat, are proposals where it's not abundantly clear to creditors that it is a viable business. Okay, so whether that it means that your expenses are too high, or ultimately there's not enough revenue, or perhaps management they've lost faith in the management of the business, or a lot of money's there's just some uncertainty, because a proposal ultimately is a process where your creditors have to say, yes, I agree to this proposal. This looks good. And I want it. I would like this option over bankruptcy. And so, obviously, if we're looking at a bankruptcy, a liquidation of assets, that's going to offer a baseline amount that's going to be available to creditors. So, worst case scenario for creditors, a bankruptcy. Well, can you make an offering that's better than a bankruptcy in a proposal? And so that's what a proposal is basically that better advantage where, hey, bankruptcy is going to give you maybe 5%, but this proposal is going to give you 20% of what's owed to you. And then the creditors have to ultimately decide, yes, I do want that 20%, or no, I don't. But key to that, them saying yes or no, is going to be really their interactions with you prior to the filing of the proposal. Again, have you been trustworthy? Have you done what you said you were going to do? That kind of thing. So it goes right back to the first slide. And then also, they need to have kind of faith that you can kind of turn it around. A lot of times, so if your business has been operating well up until the COVID pandemic, and there has been no other signs of difficulty, then there's the possibility that your creditors could say, this is a pandemic issue, and now that the pandemic is behind us, or now we know what the future looks like, they may, a creditor may go, okay, well, we can see what happened. We can see that, there was good management all the way along, and now we're good to go. But if there was something else happening besides the pandemic, then we would have to make sure to address those issues to creditors so that they had some comfort around what was happening. Maybe it was accounts receivable you had a big accounts receivable that was never paid. Well, that obviously would impact your cash flow. So what are you going to do differently in the future? Are you going to get, can you get deposits? Can you do work in process invoicing so you don't have a big bill at the end that would remain unpaid? Those kinds of things that we can kind of work with the creditors and say, we see that this was a problem before. Here's the remedies that we see. In addition to that, we've done X, Y, Z. Then that provides creditors with a lot of faith that this business is viable. We just, these tweaks were needed to be made to make it so. What happens with a business really, well, and us personally, life can happen. Things can take us by surprise, or, we can learn as we go, right? We can have an idea of how things are going to play out. It didn't play out that way. I learned from that situation. And that's all great information for your creditors to know so that they can see that, as a management team, you have matured and developed along the way. So with this proposal, the business would generally keep operating. The proposal is crafted by you, the business. So you would be getting legal counsel to help draft that. And then you'd also be required to give a retainer to the trustee for their work as well. So it's not an inexpensive process, okay? And the business can choose to pay certain secured creditors. So the nice thing about this process is that you can look at your business and you can say, in an ideal world, what would I keep and what wouldn't I keep? And the same, so for example, if you have 4 or 5 pieces of equipment that are really making a lot of money for you, you want to keep those, but you had some other pieces of equipment that didn't make a lot of sense, or made sense when you were doing a different activity, but now that activity isn't part of your repertoire, now they aren't kind of generating revenue, and that's why doesn't make sense. It doesn't make sense financially in terms of is keeping them going to be of value for the business, right? And always these things are easiest to see in hindsight, right? Oh, that venture might not have worked out as well, or that was the first version of the company, but as things got refined, we went a different direction, and now. But sometimes there's these remnants of payments that you have left over. So you can pick and choose what agreements you want to keep and what agreements you don't want to keep. So you can kind of restructure that way, which is really, which is great. But you have to keep in mind that that if you're making, so that's all fine and good. And then a proposal can be made to secured creditors as well as unsecured creditors. So, if you have a situation where you need to kind of restructure things with your secured creditor, you can propose that in the proposal as well. So the key to that, though, is that secured creditor has to say yes. And if they don't say yes, if they say no, then you'd either have to you'd have to change the proposal that would kind of eliminate that term, or what happens is the proposal would fail, because all creditors, all different creditor groups have to say yes. And so there would be a secured creditor group, and then there's different groups under the unsecured creditor groupings. And so all of those different groups of creditors, each one of those groups has to say yes. And so it can be, a proposal can be simple. It could be to, all my creditors as a group, or you can really get really detailed in how you want to approach your creditors, and to say, I want all my vendors treated this way. I want all my, all of these creditors this way and these other creditors that way. But the key to that process is that all of those different groups have to say yes. So it sounds like I'm getting kind of into the minutia. It's getting a little complicated. This is why you have a trustee and a lawyer, an insolvency lawyer, as part of this process, so they can help guide you through this process. You are not the subject matter expert at insolvency. You're the subject matter expert at welding or painting or whatever it is that you do, right? So that's why you need to get professionals that know insolvency to kind of help you through this. But so that's basically what a proposal is about.
Rebecca, for proposal, do you have to be a certain size of business to use that, or not?
No. Any business could make that, could make a proposal. And so so all along, the assumption has been that this is a corporation, right? But if you were a sole proprietorship and you needed to do a proposal, because of the structure of a sole proprietorship, if I'm a sole proprietorship, it's Rebecca operating as Rebecca's Baskets or something, right? And so that business is under my personal name. And so now we'd be looking at a personal insolvency situation as opposed to a business insolvency situation. And so that would be the one kind of caveat there, is that piece of it can change. But when we're talking about corporations, it's really any size of business can utilize this legislation, but there is for really big companies, there are CCAAs, which is a different process. It's more of a court-driven process, but any company can have access once you're over that. I can't remember the threshold. I'm sorry, I don't do them. But once you're over the threshold where you would be able to do a CCAA, that would give you the option to do a CCAA or this kind of proposal. So, yeah, so that's kind of
thank you.
The long-winded answer to that question. Okay, so let's look at.
I think we have about 20 minutes left, Rebecca, just time-wise.
Okay, perfect. So let's look at it at an example to kind of flesh this out a little bit so that you can see how we might apply this legislation to different circumstances. This example is pretty simplistic. I know a lot of us have a lot more going on in life and things like that. So that's all good. But so anyways, this is just to kind of help frame bankruptcies and proposals. So here's an example. So a hotshot business, so that's a guy that kind of drives stuff up into the oil field. He owns 6 trucks. The business owns 6 trucks. This is a corporation. The 4 are leased through national leasing and 2 trucks are owned free and clear. The company had also leased a bay to do their own mechanical repairs on their trucks. This is when they had 15 or more trucks on the road, but now with less trucks, the lease bay is starting to make a little bit less sense for them. So this is one of those situations where things can kind of change a little bit, right? And they owe $200,000 to vendors and the bank. And so this is just an unsecured creditor situation. The owner has been running this business since 1999. It was going well till 2008 when it got hit really hard. And then again in 2014, hit some difficulties because of the oil and gas prices. Now with COVID-19, it's caused a reduction in revenue again. As such, the business is they just don't really feel like it's a viable option anymore. On top of that, the owner is 62 years old and doesn't have the energy to keep the business going. So in this kind of situation, a proposal is kind of something that's less likely. Certainly this business owner could look at doing a proposal, but we're going to talk about it in the context of a bankruptcy. And the reason being is because there has to be some sort of intrinsic motivation of the business owner to keep the business going. This business owner sounds like, he's kind of been there, done that, might want to just, head into retirement from here and call it quits. And so we'll look at it from a bankruptcy perspective. Certainly, I'm going to show you an adjustment to this situation where we would look at it from a proposal perspective. Okay, so with bankruptcy, So with bankruptcy, what would happen in this situation is that the business would stop operating. The 4 leased trucks, the trustee would review the security, but assuming that security looked good, those 4 leased trucks would go back to national leasing and they would realize on them to kind of offset that debt, okay? The 2 trucks that were free and clear that had no security against them, those trucks would be sold and the proceeds of those would go into the bankrupt estate and they would be distributed. Available distributions would be distributed to the unsecured creditors. So you can see how the secured creditors take the specific assets that they have an interest in, and then whatever is left in terms of assets would go to the unsecured creditors. And then in a bankruptcy, the trustee would likely terminate that commercial lease for the bay because with the business stopping, there's no reason why that lease would continue. And then that landlord might have a claim in the bankrupt estate depending on if they had anything outstanding to them. Okay, so this is a situation where you can see how the secured creditors get treated a little bit differently than the unsecured creditors, just because they have those first dibs on specific assets, and then anything left over again would be distributed amongst that $200,000 that is owing. So let's assume that the trucks maybe are worth 10 grand each, 20 grand's coming into the pot, and then after our fees and after everything that kind of comes out of the pot from as is required for us to finish this process, then they would kind of get a dividend after that. So you can see how most of this $200,000 is probably going to be written off in this kind of situation. So let's take this same company and tweak it just a little bit. So say a different hot truck company, still 6 trucks, 4 are leased, 2 are owned free and clear. The company has leased a bay to do mechanical repairs on their trucks when they had 15 trucks on the road, but now with less trucks, the lease bay is too big just to kind of do their own repairs. So what they've done is, instead of, they've diversified their service line and they started offering mechanical services to make use of that leased bay, which has increased their revenue. They're still having difficulty getting out of debt entirely, but they found a way to take what they had and do hot shot servicing and mechanical, so they kind of diversified a little bit. Now with COVID, it's, again, we've got a period of not working or not working a whole heck of a lot. They still owe the $200,000 to vendors and banks. And the owner is 39 years old and positive that with this diversified business, it can be successful and they just need a fresh start. So This is a situation where, oftentimes what can happen is that you learn along the way what works and what doesn't work, but sometimes the financial situation it can be too far gone to actually be able to pay all of it back, but you've kind of refined your business along the way and been able to figure out the best way to operate. Well, this a proposal is a great idea in those circumstances because what we can do is look at an option for repayment. So again, those 4 leased trucks that have secured debts against them, the business could decide which of these vehicles they wanted to keep, which are helping to build the business, and which ones are unnecessary. Perhaps the oldest truck is that's kind of become a bit of a where they have to kind of sink a bunch of money into it. Perhaps those leases could be terminated, and then the 2 trucks that are free and clear, that have no security agreement against them, they could keep those trucks running. Okay, so those trucks are valued at $14,000 in this example, and so the business has decided to keep the leased space. They can decide to keep that leased space or terminate. So they could look at the situation and go, actually, this diversified business model is really working great for us. We just kind of initiated it a little too late, and so we're going to keep with that model. Or they could go, we tried to diversify, it didn't really work, so we're going to get rid of the lease and we're just going to keep the 6 trucks. So they can pick which direction they want to go in terms of what's going to work really well for them. So in this example, we could say that the business proposes to the unsecured creditors that over the next 5 years, the business can pay a total of $10,000 into the proposal, or $100,000, sorry, into the proposal. This is clearly better than the $14,000 that would go into the bankruptcy, right? And then our fees and what happens, how we get paid for this work is out of that $100,000, and so we would get paid again first, and then the creditors would get the majority of those funds to go towards their debts. And so from a creditor's perspective, you could see how a proposal might be a better advantage than the bankruptcy, because in the bankruptcy, even though there's 6 trucks, 4 of them are secured, so the secured creditors are going to get that. So there's really only 2 trucks left over for those unsecured creditors to have a piece of. So in this situation, that $100,000, if they were able to pay it over that 5 years, is definitely a better advantage for creditors. And so creditors what they'll do is they'll review the cash flow of the business, they'll review the proposal, they're going to take into consideration, again, past events to determine, is this business operating in good faith, and can we, should we say yes to this? And then they will vote to accept the proposal or not. What we need is a majority of the proven debts to say yes. There's 2 tests in a proposal. It is that the majority in numbers say yes, and then the 2/3 majority in value say yes. So of this $200,000, 2/3 of that debt needs to say yes, and that has to form the majority in number. So anyways, that's kind of the nitty gritty, but basically what we're looking for is majority. What we don't have down here that's key to know is that with a proposal, if we don't get those majorities in play, then it's automatically a bankruptcy. So the stakes are pretty high when we hit proposal. That's why we want to consider all of your options before we start looking at proposals and bankruptcies, because we want to make sure that we've exhausted all of those insolvency options, so that hopefully you could do that without doing a proposal or bankruptcy. But really, once you hit proposal or bankruptcy, you're really looking at only those 2 options anyways. Once you hit a proposal, if it ends up in a bankruptcy, well, that was your other viable option if you're kind of at that point. So our businesses are very much very important to us and a part of who we are, right? So the stakes of the game are high. So So the last thing I want to kind of talk about is on a personal note, how this might affect you personally. So business debts that can flow to directors and shareholders of a business. And so let's look at what those could be. So GST, so if GST remains unpaid, if the corporation does not pay it, there can be a director's liability for that debt. So remember, we talked about GST having a deemed trust, and it had these, superpowers in terms of enforceability. That doesn't exist once it transitions. So that exists only in the corporation. If that debt is also payable by the director, it becomes a simple unsecured debt. They don't have any other of their superpowers, okay, when trying to collect against the director. It would just be a regular requirement to pay or garnishment that could be in place instead of that enhanced requirement to pay. And I should say, however, they still can register writs against you personally, your personal property, if they have that director's liability in place. Same thing goes with the payroll remittance. It doesn't become this debt that must be paid. It can be discharged. It can go away in a bankruptcy or proposal. But there is, so when it comes over from the corporation to the director, it changes kind of form and it just becomes, again, that unsecured debt. There can be a requirement to pay and there can be a writ, but they can't issue that enhanced requirement to pay, and it doesn't survive, come what may. Corporate tax. You should talk to your accountant about Section 160 of the Income Tax Act. It lays out specific situations where shareholders can be held liable for corporate tax unpaid if shareholders have received a dividend. So talk to your accountant about that. Really, dividends are fantastic if the business is succeeding and off you go. But when the business is success is less viable, then we're in a situation where dividends might not be the best way to take income. So talking to your accountant about that and strategizing with your accountant is really important. And other things that can kind of come to you. Oh, sorry, I don't know how I did that. Other things that can come to you as a director. Oh, sorry. Last thing about corporate taxes. Shareholders sometimes can be the director, and like say husband owns the company, is the director, and then husband and wife are shareholders. So what can happen is husband and wife can be held liable for this corporate tax if there's an assessment made under Section 160. So be careful, because what was just his financial burden might kind of flow over to her, or vice versa, in that situation. So that's where spouses can kind of get pulled into this process and into owing some money. Okay, and then unpaid employee wages can be something that can come to a director. And then personal guarantees. Obviously, if you have signed when you got your bank loan, if you signed to be a personal guarantee for that debt, that's going to come over to you personally, as well as when you have situations where you and your business have signed on the dotted line for a lease or agreement. That is also going to be a situation where there's going to be something kind of flowing to you personally. So in conclusion, it's complicated. There's a lot of things going on. We've got lots of things going on in your business, and if you're homeschooling children on top of it, and all of those things, like COVID has really brought a lot of pressures to bear on us personally, as well as within our businesses. And it is a bit of a juggling act. If you are struggling financially, we definitely recommend having conversations with someone sooner rather than later. Keep communicating with your creditors. I think that's a common theme throughout this whole presentation that you can kind of take away. Talking to an insolvency lawyer sooner rather than later, and then talking to a licensed insolvency trustee just to get some information sooner rather than later is really important, so that you can get specifics on your unique circumstance. And because the sooner you have those conversations, the better. But when you're on the cusp of not making payroll, you're really behind on a lease space that you really need, the conversation gets harder, right? And the options kind of narrow. And then we get to a situation where it might be harder to keep that business running. So having those conversations if you're struggling, sooner rather than later is definitely the thing I would like to drive home, if anything, because really we want you to succeed. We want you to not need our services. I don't want you to need a bankruptcy, and I don't want you to need a proposal, but if you need us, we're here, right? But ideally, we keep these businesses running. So knowing what the worst case scenario is really helps you kind of strategize when you are deciding how to move forward. So if you go, okay, well, that's the worst, and it also lets you kind of helps you make a decision about, okay, if you're gonna pull your chute, when do you do that? And in the meantime, who should you be paying as credit? Which creditors should you be paying, and that kind of thing. So having that conversation. We're not here to sell you bankruptcy. We're not here to sell you proposals. We're here to give you information. So just keep that in mind. And that's my that hour went quickly, almost an hour. And I just like to offer up if anyone has any questions.
Great. Yeah, I think that was, really informative. There's definitely a wealth of knowledge that you have, and it can get complex, as you mentioned. But I think the big takeaway for me from all of this is really there's options out there, right? So bankruptcy isn't the only one. There's tons of different options that one can kind of pursue and kind of make sure they're talking to the professionals who can help them out, right?
Yeah, absolutely. Yeah, and yeah, just that the sooner the better, because the farther we get down the line, it's the less options you have, and of course we want the most options to be able to give you so that you can hopefully make it out of this with living your ideal life, right? Yeah, and with your business intact. Yeah.
For sure. Awesome.
I'm just going to move to the last slide here. This is some really great information. Business Link, I just want to put a plug in for them. Obviously, you guys have found your way here. So you obviously find that Business Link is an amazing resource for businesses, especially at this time. They've been working really diligently to keep relevant information in front of people as this COVID pandemic has has gone on. And so I just want to send a huge shout out to you guys. Thank you so much for supporting Alberta businesses, and we really appreciate everything you do.
Awesome. Well, thanks so much for that, Rebecca. We really appreciate it. We are working hard for Alberta businesses, helping them kind of move forward and succeeding kind of during this time, especially. Thank you so much, everyone, for joining our webinar today. Thank you to Rebecca for sharing her expertise. We really appreciate that. And if anyone did want to reach out to Business Link, you can email us at askus@businesslink.ca or call us toll free, 1-800-272-9675. If you're looking for one-on-one advice, or if you want to sign up for our e-newsletter, join us on social media, chat with us online, or stay informed with upcoming events, workshops and whatnot, definitely visit our website, businesslink.ca. And all of our participants will be receiving an email following the webinar with a link to a post-webinar survey. So please take a minute or two to complete that survey, and we really appreciate that. So that's it for today. And thank you so much, everyone, and enjoy your afternoon here. Take care.
Thank you so much.